Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined today by my good friend Cameron May, also an education coach, 20-plus year veteran of the financial markets. He's out there in the chat to help answer your questions specifically about this particular discussion. And speaking of out there in the chat, welcome to all of you that are joining us live. Whether you're joining us here in that live version, you can chat in. If you're joining us in the recorded version as well, welcome to you. You can join in the conversation by leaving comments in the comment section. We'll respond to those as quickly as we can. But hey, we're going to be talking about index options as we have been in this particular webcast. And we're a couple of episodes into this year for trading index options. And I wanted to come up with something today in response to a question that came up in one of our feedback surveys, and that was, can I use index options as a way to generate income on a regular basis? And so we're going to explore those ideas today, the idea of perhaps selling weekly index option spreads, and we'll see what that looks like in this discussion as we get into the discussion today. But again, welcome to all of the usual suspects here and those that I've met out there in the live events that we've been doing all around the country. We've got another one coming up next week in Seattle. By the way, I won't be here next week, so it will likely be Brent Moores or Cameron May helping out tomorrow or next week in this index options webcast. But let's jump in here and take care of a couple quick housekeeping items, and we'll get started with the discussion here. As we do this, again, remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation or any kind of advice about a security or a pattern or a strategy or particular investment. Remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions and transaction costs. Remember that spread trades must be done in a margin account. And make sure that you understand, again, those characteristics and risks, that when you go long an option, there's the risk of losing 100% of the funds invested. When you're short an option, that carries with it certain obligations. We'll talk about that in the context of index options today. We're going to use a lot of technical analysis. We're also going to use some probability analysis today. Both of those concepts are theoretical in nature. Neither one guarantees any kind of specificity about what the market is going to do or about an index or anything else. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that. Great learning environment. Doesn't do a couple of things that a live trading platform would do. It doesn't allow for studies to be used in scans, and it doesn't facilitate the early assignment of short options. Now, the fortunate thing is the majority of the indexes that we're going to talk about today in this discussion and in this class on an ongoing basis are what are known as European style indexes. That way, those options on European style indexes can't be exercised until expiration, as opposed to an American style short option, which can be assigned at any time up to expiration, regardless of whether it's in the money, at the money, or out of the money. So we're going to pay attention to that. Again, past performance of any security or strategy doesn't guarantee future results or success. And when we talk about stop orders, even stop orders on indexes and index options, remember that stop loss orders will not guarantee an execution price, simply allow us to specify an activation price. And remember, even with stop limit order, there's the potential for the price of an index or the price of the underlying security to gap around the stop and the order not fill at all. So we'll talk about that as we get into these discussions specifically, and I appreciate all of you joining in and paying attention to this discussion. We're going to talk a little bit about index options and what we've been doing, and we're going to talk about a specific strategy today. In fact, we're going to put this strategy together in this discussion today. So this is going to be kind of a hands-on working session here And we're going to focus on a couple of things. We're going to focus primarily on verticals and iron condors in this discussion. For my idea behind selling index options on a regular basis to generate income. We're going to use a risk-defined strategy. I know that some traders out there, because of the lack of risk of early assignment in European-style index options, may consider selling naked index options. We're not going to do that. We're not going to talk about that. We're going to focus on risk-defined strategies, namely verticals and iron condors, in this discussion to generate income. So we'll see what that looks like. We're going to talk about that. If you want more information about those two particular strategies, verticals and iron condors, we've got a variety of webcasts in our webcast library, not only of recorded webcasts, but also upcoming live events where you can learn more about those specific strategies, verticals, iron condors, both short and long verticals, both short and long iron condors. And we'll talk about those along the way, and I'll give you some resources that you can use. But let's do this. Let's clip over to the thinkorswim desktop software platform here. And as I do so, quick reminder, click on that subscribe button down at the bottom of the page there. That's going to be a great opportunity for you to stay connected to the Trader Talks webcast channel. It's a no-cost subscription to you, keeps you connected, keeps you in the know about what's coming up as far as new content, new webcasts, and posted archives. So looking forward to you doing that. Just click on that subscribe button, and if you've not done so already. Now, let's jump into this discussion of index options by looking at what the indexes are doing, the primary indexes. That's kind of one of the main uses of indexes in general, is kind of tracking what the market is doing. Many traders will use indexes as a benchmark for how their own portfolios are measuring up to market movement. We've talked about a number of different indexes that we might use in this particular class, but let's take a look at the SPX and the NASDAQ and the Russell 2000 specifically, those three, kind of the general broad cross-section. And boy, I'll tell you what, we've seen some interesting movement. I'm going to just zoom in onto this time frame on the SPX. This is the S&P 500. And I've got a lot of lines here on the chart. I recognize that, but let's kind of walk through what we're talking about here. And I'm going to kind of squish this a little bit so that we can see it, and maybe kind of zoom in on a particular time frame here so you can see that range that we're looking at here. The SPX has generally been pulling back in kind of an intermediate term downward channel, with the exception of the last 3 days where it's broken out of that channel. We saw this little bit of a bounce and a pop above the 50-period simple moving average. And whether you use an exponential moving average or simple or Hull or anything else, whatever you use, this is simply a line of demarcation that says, hey, this is above that average price for the index over a period of time. And so we've seen a move above that 50-period moving average. We've seen a continuation of that with a little bit of a gap higher. And then today we see another continuation of that move with yet another gap higher and a little bit of a run. So gap up and run, gap up and run, gap up and run. And it's broken above this horizontal resistance. In fact, it's approaching kind of the next level of horizontal resistance, kind of up here around the 6,100 level, right? And so if we were to draw that in here, we might say, look, right around that 6,100 mark, there is perhaps a little bit of a resistance level. The question might be, does it break through that previous high, or does it hit this level and does it bounce down? And I think if we see the break, just from a toggle standpoint, right? This is one of those technical toggle, well, it's technical toggle. We used to call it technical toggle Tuesday. Now it is technical toggle Wednesday because we do this webcast on a Wednesday. So we got to come up with a different alliteration for that. But looking for that breakout of that resistance level to toggle higher, right? A break above that resistance may be an indication that we see a continuation of the longer term trend, as indicated by the 200-period moving average here. We see this breakout of that squeeze that we saw in RSI, relative strength index. That relative strength index is simply a measurement of, if you want to boil it down, and I know Cameron does a great job of this, and I'll let Cameron pop the link into the chat for his Getting Started with Technical Analysis webcast that he has done, where he's talked about and broken down a number of these different technical indicators. And I know he's talked about the RSI on a variety of occasions, but if you want to boil down the RSI, that relative strength index, it's a momentum gauge, if you will. It's the oomph behind this movement. And so we've seen that kind of consolidation of momentum, and now a breakout of momentum, right? A big push. And we've seen that over the last 2 or 3 days here, corresponding with what's been going on the RSI. Now, does it have enough momentum to break back up above that resistance level? That becomes the question. Overall, the trend, though, is still intact. So let's take a look at the NASDAQ and kind of get a sense of the same scenario here. And we see the same kind of thing happening, right? Big run, break of the diagonal, gap up and rally, gap up and rally. Big move in the RSI, again, above the 50-period moving average, 200-period moving average still moving higher. Big momentum move in the RSI. So the NASDAQ, technology-heavy index, also moving with some pretty strong momentum. And also, coincidentally, not quite at that horizontal resistance, which we would probably place at this point if we were going to draw a technical resistance level, just coming off of these previous highs right back here, about this 22,160 level. And if we look at the Russell 2000, this is the small caps, and this is the one that we've been watching on a number of occasions. In fact, last week, not only in the index options webcast, we looked at it as a hedging vehicle, but we also looked at it in the trading futures webcast, which comes up on Thursday mornings, and looking for that little bit of a bounce to the downside at that resistance level. It didn't really bounce. It's now bouncing down, however, from that 50-period moving average. RSI is breaking higher, although pulling back a little bit. We can kind of see what we've got going on today in this move where it's running into the 50-period moving average and bouncing down. We might call that, if we were candlestick aficionados, you might call that an advanced block, is what some traders may refer to. It may also be an inside day. It might also be a bearish harami if you are candlestick literate and familiar with some of those names. Regardless, gives us an indication that we got a little bit of a bounce down. You see that 50-period kind of rolling just a little bit on the right-hand side there, rolling down somewhat. So a bit of weakness in the Russell 2000 after a couple of strong days to the upside, and kind of running right into that resistance around this 2323 level. So a little bit of a pullback in the RSI. So that kind of gives us an idea of what's going on here from the standpoint of this overall movement. Now, before we jump into this weekly selling strategy that I wanted to look at, I wanted to do two things. One, I wanted to look at volatility. So we're going to pop over here to our VIX grid, and we're going to look at the VIX as a whole. Maybe if that comes up, we'll see if that does. There we go. There's our VIX. VIX has generally been bleeding off. As the market's been moving higher, the VIX has been coming down. We saw a little bit of an kind of increased volatility last week as we saw a bit of a downward move in the market starting to break and ahead of, say, for instance, the presidential inauguration. Now we're starting to see that volatility bleed off. Still staying a little bit elevated from where it has been, though, staying up in about that 14 handle or so. So a little bit of volatility staying in there. That's one thing. Two, I want to come back over here to our monitor tab, and I wanted to look at the use that we put our Russell 2000 or our RUT option to use for last week. And what we did is we beta weighted our stock portfolio to the Russell 2000. And remember, we had about 125, 126 Russell 2000 deltas. If you want to learn a little bit more about beta weighting, this is something that we'll do. Cameron, I'm going to ask you real quick if you'll go out and grab the Protective Strategies playlist, which is a webcast that we did in this place up until the beginning of this year, but we talked a lot about those hedging strategies and beta weighting portfolios. So that's what we did. We bought a Russell 2000 index put to provide some offset to that exposure. I'm going to move that back down to our stocks group, and we can see that that reduced our exposure by a little bit, but we can also see what it's been doing. So we bought it for $24.45, knowing that our intent was not necessarily to make money on this hedge, but what's gone on is that put option has become less expensive. We've lost money in the put. And generally that would indicate that the overall exposure of our portfolio, this stock portfolio, has been moving higher because we lost money in the put. That means the index that we were using to beta weight this was going up instead of down. So doing that, did exactly what it was intended to do, even though it lost money. We weren't intending to make money on this particular put option. We were using it as a position to offset potential downside movement in this portfolio if the Russell 2000 broke down, because we had some exposure there. So now that we've kind of rolled off a few days, this has 9 days to go until expiration. Time decay is really going to start to eat away at this from that standpoint. So we're going to look at taking this off, salvaging what time and value is remaining there. And then when it appears as if we need to hedge this portfolio again, let's say we get more downward movement out of the Russell 2000, then we may put a hedge protective put on, or a hedging put on, again, using the Russell 2000 or using another index. So we're going to simply close this one down by buying it back. So I'm going to come over here and we're going to right click and we're going to create a closing order, and we're going to just sell back this long put option that we had and capture whatever value we can capture remaining here. And we're going to go ahead and we're going to click on confirm and send. We're going to read through the order, make sure that's what we want to do. Make sure that it says to close, because we're going to close this down, and we're going to click on send, and we're going to fire that order off. And we close down that index option that was providing that hedge. Now, let's pop back over here to our charts for just a second. And I wanted to go to a grid that I've built here, and I'll share it with you actually in the chat. But this is the grid that I built here. I'm calling this the index options grid, and it's got a couple of things on here. It's got on the left hand side a 1 year 1 day chart. On the right hand side, it has a 3 month 1 day chart, so that we can start to see the shorter time frame. It's got a 50 period simple moving average, like what we were looking at on that longer term chart. It's got a MACD, or a moving average convergence divergence. Again, another one of those indicators that Cameron talked about in his webcast. I've got a couple of other things here on the right hand side, on the shorter term side. I've got this probability of expiring cone, and I'm going to explain this here in just a second. And then it's also got implied volatility. So if we're looking at SPX and we're looking at implied volatility, so SPX is the symbol in this particular case, and we're looking at implied volatility, that's going to look very, very similar. That's going to look very, very similar to the VIX, because the implied volatility of the SPX is roughly a proxy or an approximation of what the VIX is doing, right? The VIX, it has a different methodology to a certain extent, but it's going to give us a rough approach, right? So as we kind of look at that, this is what our grid does. I want to answer a real quick question Snowy asked before we get too far away from that. Do we weigh the cost of the put hedge versus a stop loss when deciding about a hedge? And the answer to that is absolutely yes. You got to weigh those two in the balance. But think about this. We were using that hedge, that put option on the index, on that broad index, as a means to offset potential downward movement in a stock portfolio that had like 10 or 15 stock positions in it. So we could do one of two things. We could buy the index put to provide some offset, which is going to cost a certain amount, Or we could put stop losses potentially on each one of those individual positions, which is going to cost us nothing but time and attention in terms of maintaining those stops. So, you've got to kind of weigh those two things in the balance here. Okay. So let's get into this particular strategy. Now that we have the tools kind of outlined here of what my intention is. So my thought process was, and this came as a question in one of the feedback surveys, which was, can we talk about a strategy that generates income from selling index options on a regular basis? And so I started to think about it, and I've done something like this before on a variety of different approaches. But I wanted to kind of pull this together as we talk about this, because I think it presents some interesting concepts here, right? So we're using the SPX. I'm going to use the S&P here, kind of the broadest sense of the market, if you will, kind of that broad cross section. And the idea being that with a reasonable amount of attention to this, and again, these are not set it and forget it trades in any sense. When we talk about trading options in any sense, are they set it and forget it trades? We got to pay attention, right? Attention must be paid, in the words of Stephen Sondheim in the musical Assassins. Attention must be paid. So we'll kind of bring this into the context of what we want to do. The idea would be that we sell on a regular basis a vertical spread or an iron condor to generate income, and then we close that down on a regular basis. And then from that, we can kind of ladder that approach so that we've always got a vertical spread or an iron condor expiring or coming to our selling point, and so that we've got that consistent generation of premium on an ongoing basis. It can be then an engine to generate that income. So here's what we're going to do, and I'll kind of outline the steps here. And as I do that, I'm going to put those points here in the scratch pad. Oh, by the way, first of all, before I forget about it, thank you for mentally reminding me of this. Did I share the grid with you? Okay, remember, when I share grids or anything else, when I put those here in the chat, those are for illustrative and educational purposes only. They are not guaranteed as to time or accuracy, but you've got that out there in the chat. You can pop this grid into your own iteration of the Thinkorswim platform. If you don't know how to do that, I'm going to ask Cameron to go grab one of the Getting Started with Thinkorswim webcasts that he's done that shows how to import shared items and open them up. So for those of you that maybe are newer to the Thinkorswim platform, can get some sense from that. But let's talk about this. So we're going to go to the Trade tab for the SPX, now that we kind of have a sense of the tools that we're going to use. So my thought process was this, and I'm going to grab my magic marker for this, that the idea being we want to do this on kind of a weekly basis. The great thing about an index option, or one of the great things about index options, is that we have expirations of these index options on almost a daily basis. In fact, barring the weekends, we have some regular expirations every weekday. So my thought was this: we kind of can set up a consistent approach to selling a vertical spread or an iron condor 14 days out from expiration, and then looking at buying it back 7 days out from expiration. And the reason this works in this sense, and for no other reason necessarily, is that we can do this on a weekly basis here in this class. We can sell the vertical spread, and then we can look at the next week buying it back. And if we do it every week, then we've always got something to talk about. So that's going to be our approach. So in this sense, here's what we're going to do. I'm going to just outline these kind of bullet points here. And again, these are not rules. These are simply considerations. So sell 14 DTE, buy back at 7 DTE. Okay, and the idea is we're going to capitalize hopefully on directional movement, but also time decay and perhaps even implied volatility collapse. So Sell a vertical spread at 14 DTE, buy it back at 7 days DTE. Does it make sense? Okay. So now the next approach that we're going to take is where might we sell this vertical spread from a strike price standpoint. So for that we got to go back to the chart. So we're going to go back to the chart grid. Okay. And I'm looking at two things. One, I'm looking at the upward trend of the SPX over the course of the 1 year time frame, right? Like we talked about. And we're knocking on the door of breaking out to new highs. And we've got some strong momentum. We saw the strong momentum move on the RSI. We're seeing the strong momentum move on the MACD, giving us that strength. So we're going to be looking at taking this in a bullish direction. If this were going sideways, we would potentially be looking at trading that neutral direction by using, say, for instance, an iron condor. But we'll talk a little bit more about that. Now, here's the thing we're going to do on this right-hand side is we're going to use this right-hand side to give us an approximation of where we might sell our vertical spread to bring in premium at a level that's not likely to be hit. We're going to take the Wayne Gretzky approach, or kind of the anti-Wayne Gretzky approach. Well, it is the Wayne Gretzky approach because he said, skate to where the puck isn't, right? And so, or where the puck's going to be. And so we're going to sell where the market isn't, or where the index isn't, and where it's not likely to be. So what I'm going to do is I'm going to use this probability of expiring cone. And the probability of expiring cone is influenced by implied volatility. And so when implied volatility is higher, the probability of expiring cone gets wider. When implied volatility is lower, the probability of expiring cone narrows in its focus. So this just gives me kind of a one standard deviation look at where the market might be based on current implied volatility levels. It's almost like expressing that expected move in a cone shape on the chart. So what I'm going to do is I'm going to come back over here to my trade tab, just cross-check. Where's my 14 days to go until expiration? That's at 5 Feb expiration. So 5 Feb expiration, 14 days to go until expiration. So I'm going to look here at the charts, and we're going to come out here and we're going to put this time frame wise on February 5th. And so what I'm going to do is I'm going to come down and I'm going to look for the intersection of February 5th, in this case, 14 days to go until expiration, and that probability of expiring cone. And that's right around the 59.24 level. You see that 59.24 on the right-hand side. So what I'm going to do is I'm actually going to grab my line tool here, and we're going to make that line on the chart, and we're just going to grab it right here. We're going to say 59.20. I'll call it 59.25 just for round numbers. 59.25, and we'll just put that line right there. Click. Now we've got that line. That's going to give us a one standard deviation level for price as a potential support level. And let's see if that lines up with any other levels of support. And look, if we go back to the left, always a good idea to perhaps check left to see what's going on right. Check left to confirm right. So we go over here and we say, all right, is there support at that 59.25 mark? And I would argue resistance here, resistance, resistance, support here, support, resistance, resistance. So that area, I think, has enough touches at that level from a logical standpoint that this becomes a reasonable support level to sell at or below. So we're going to sell a vertical spread at or below that 59.25 level, and we're going to take it off when we get to 7 days to go until expiration. So let's go back to the trade tab now that we know where our level is, 59.25. So let's annotate this. So we're going to sell vertical spread. In this case, it's going to be a put spread at or below one standard deviation. I'll just do ST instead because I can't get to my sigma key here. One standard deviation support. Okay, so sell a vertical spread at or below one standard deviation support. That's based on the probability of expiring cone. So there's our second point to this strategy. So we're going to go to the trade tab. We're going to come down here to the 14 days to go until expiration, And we know, let's just cross-check, 59.25. We're going to go back to the trade tab. We're going to come down and we're going to find that 59.25 support level. Let's go to 59.25. And in fact, we got to go out more than 60 strikes here. Okay, more than 60 strikes. Let's go to 80 strikes. Again, a lot of strikes that we can use. 59.25 is right there. 59.25. It's about the 14 delta, right? 14 or 15 cent delta. So here's what we're going to do. We're going to look at selling the 59.25 and we'll buy the 59.15. Okay? So we're going to bring in a $1.05 credit. Okay, look, now we can adjust this, right? That's one standard deviation. And volatility, remember, we said is relatively low. So we're going to say, look, we're going to try to get a buck out of this against a $10 spread. And you're going to say, well, wait a second. That's not a great risk to reward, right? We're a reward to risk ratio, right? We're picking up a buck potentially and risking 9.05 or risking $10, $9 in this $10 wide spread. But here's what we've got to think about is two things in putting this together. We're at the 14 delta, which means that from a probability standpoint, if we use that 59.25 as kind of the proxy and kind of our risk definition, that, okay, that means that this has about a 15% probability of being in the money at expiration, which would give us our theoretical maximum loss, right? Which means that it has about an 85% probability of being out of the money at expiration, which is what we want to have to do, right? Now, we're not going to hold this to expiration. We're simply going to sell this far out, 14 days out, which is where we are, and we're going to buy it back. And we're going to simply see how much of that we can harvest in this particular case. So the ACF is a great question. You know, at 59.25, there's only one traded volume today and 32 contracts of open interest. So we can do that. We can just show volume and open interest here real quick and see if there's something that maybe has a little bit more. And here's the thing about these SPX options. These are going to become more liquid as we get closer to expiration because oftentimes there's a little bit more activity that happens. But if we see something that doesn't have a lot of open interest, and I'm okay with 57 or 67 contracts of an open interest if we're just going to sell 2 or 3 or 5 contracts. If we're going to sell 50 contracts of this, or a trader was going to do that, that may be a concern because then you're the big fish in the small pond. We don't want to be a big fish in a small pond. We want to be a small fish in a bigger pond, right? So then we could adjust. I mean, we could bring this into the 59.50 if you wanted. We can adjust that liquidity, right? And the other thing, Chris, is in this particular case, Chris has a great point. We could create this as an iron condor and sell the call spread as well to maybe bring in a little bit more premium. So there's a couple of different ways we could do that. We could up the premium by selling the vertical on the call side, or we could up the premium by increasing the number of contracts that we sell. So depending on where we are, we can put that together. But I want to establish the baseline here, right? Okay. So how did I choose 59.25 in the first place? I went to the probability of expiring cone 14 days out, and I looked at where that intersection was of price, Bob, versus the time. And that's the range where the market is expected to be based on current levels of implied volatility. So that's where I was looking at that 59.25. That's where it came from. So we're going to look at selling that one right out here. So we created that vertical spread. Let's pop this back up. And the idea is we're going to try to get a buck for this. So I'm going to work this order a little bit and see if we can get that for $1 in this particular case. So we're now going to come and confirm and send, read through this order. Now, here's the other thing to think about is that we don't have early assignment risk. So going a little bit closer to the at the money position isn't necessarily going to increase the likelihood of being early assigned because we can't be assigned early in this particular case. So it gives us some latitude to adjust that, but it gives us a greater price risk, right? And the further out we go in time, the greater there's in terms of volatility of price. But if we're looking at a 1 week time frame, there's not a lot in which the index necessarily can do, barring black swan types of big moves. So we're going to look for this. We're going to read through this order, make sure that that's what we want to see happen. We're going to put this in our index options group, and we're going to go ahead and we're going to click on send, and we're going to fire that order off, and we'll see if that fills. And it did. We got it for $1. Okay, we got it for $1. And what we're going to look at doing is closing this down 7 days prior, right? So we're going to close this down when we get to next Wednesday. And the intent is that the market's going to continue to move in a bullish direction. This is going to get cheaper and cheaper. We're going to be able to buy it back for less than we sold it for to begin with, right? And that's the intent here in selling this strategy. So the next rule or the next consideration would be here, buy back at 7 DTE. There you go. Buy back at 7 DTE. So this is kind of the thought process, right? We sell 14-day DTE or 14 DTE at 1 standard deviation support, and we buy it back at 7 DTE, whatever it's at. All right. Okay. So and you could absolutely use the theoretical price calculator to see what that's worth. So let's look at that really quick. Snowy, let me answer your question really fast here. Understand we're using the probability cone. How do we read standard deviations from it? So let's go back to the probability of expiring cone for just a second. So I'm going to go to the chart, the probability of expiring cone. So I'm going to go to my flask icon up here at the top. I put on the probability of expiring cone, and I'm going to go to the little gear icon so that we can see. And I'm going to say probability range. 68% probability. 68% probability in this case is going to be 1 standard deviation, right? 68% probability is 1 standard deviation. So this probability curve is showing a 1 standard deviation range that expands over time. You can see a similar tool. If we were to go to, say, for instance, the Analyze tab, and you were to look at probability analysis, right? And you can change that range, right? So there's 1 sigma, there's 2 sigma, that's 2 standard deviations, there's 3 sigma, that's 3 standard deviations, and you can see how the curve changes based on that. It narrows down. So we're going to go out, I'm just going to zoom in, or actually squish this over so that we can see where's our 14 days to go until expiration. It's right here, right? There's our price slice at 14 days to expiration. And if I change my 2 standard deviations, 3 standard deviations, you can see where that changes and where that level is. So that's 3 standard deviations. That's 1 standard deviation. You can read it right off of here if you want to. Okay? Yeah, each end of the curve is 1 standard deviation. Okay. All right. Good point. Thanks, Cameron, for answering that question on the diagonal. We could diagonalize this too if you wanted to. It's going to be a little bit less potential. It's going to be a little bit higher expense potentially for that as well. All right, so here's what I'm going to do. Let's go back to our trade that we're looking at, right? And, oh, we filled the trade, right? So let's look at our position then. So let's take this off, and let's take our Iron Condor off, and let's just look at the risk profile for this vertical spread. So the idea is simply this: in this SPX vertical spread, this is the 5 Feb expiration, and that's what that curve looks like, that risk and return profile. If we were to do this, set slices to break even at expiration. Break even is 59.29, so as long as this stays above 59.29, we're at break even, and our expectation is that simply the trend is going to continue, and we're going to continue to see this to move to the upside, and then we're going to buy it back. So let's go back, and I wanted to answer Bob's question, which was, wait a second, couldn't we just use the theoretical price calculator? So let's do this. Let's change this to a vertical spread. Since we went 1 strike, let's go vertical 1 month, 2 strikes wide vertical spread. And here's our 59.25, 59.15 vertical spread. We sold it for $1. I'm going to change my layout to theoretical price and mark. And we're going to play the what if game here for just a second. We're going to reset that. And we're going to say, all right, what if, why is that not resetting? There we go. Now it's resetting. Okay. Now, what if we get to 7 days to go until expiration? So what do we know about 7 days to go until expiration? What's the date for our 7 days to go until expiration? We can come back down here and say 29 Jan, right? So we're going to play the what if game, and we're going to say, all right, what if price now continues to move and we're at the 29th of January, right? That's this Wednesday right there. 29 days to go, or excuse me, 7 days to go until expiration. Let's see what our theoretical, assuming that the price of the underlying index doesn't move at all, what does time decay simply do for us? And so at our vertical spread, which is this one right here, whoops, that's that one right there. What's our theoretical price? About 50 cents. So we picked up about 50% of that premium, right? About 50% of that premium in that 7 day time frame. And then we just do it again. And we do it again. And we do it again. So listen, all we're doing in this particular case, and that's just review, all we're doing in this case, look, is we're going out 14 days to go from expiration. And we're selling a vertical spread at 1 standard deviation. And then we're simply buying it back 7 days to go until expiration. And we're claiming any premium that we get on that during that time frame, right? The difference between what we sold it for and what we can buy it back for. And the expectation is, because we're doing two things. One, we're selling the vertical spread here outside the range of where the index is likely to be. Number one, it's likely to be less expensive. So we're able to buy it back for less than we were paid for it to begin with. And two, since we're following the trend, the expectation is that the index is moving higher, right? Okay. Now, listen, how do you manage it if the trade's going against you? Jerry asks a great question. How do we manage it if it starts to go against us? We simply close it down at 7 days to go until expiration. And we either take that loss or we take the gain. It's a binary scenario, right? You could, yeah, and you could close it down prior to, but the idea is we're going to do this on a regular basis. And if the trend stays intact, the time that maybe we would change this is if the trend changes. But we're going to simply sell it at 14 DTE and buy it back at 7 DTE. And we're going to see how this works, right? Assuming this is a bullish trend and the bullish trend continues. If it's a bearish trend, we sell call spreads. If it's a neutral trend, we sell iron condors. The same thing. So we're going to continue to examine this particular strategy. We're going to see how this trade goes next Wednesday. And remember, index options have no early assignment if they are European style. So is this a trade where we could lose money? Yes. We know what our maximum loss is. We've defined our maximum loss. Is it a trade where it potentially could make money? Yes, assuming that the trend moves in the direction that we want it to go, and assuming that implied volatility falls and all of those functions of a vertical spread. But we're simply doing this on an ongoing basis. Every week, 14 days to go until expiration, selling a vertical spread, buying it back at 7 DT, which means that we're then buying another one 14 days out. And you don't have to just do it on a weekly basis. You could do this every day. So we could go 14 days today, 14 days tomorrow, 14 days the next day, and you'd start to ladder those together. And you could use a delta of 15. Your mileage might vary based on implied volatility, but great question, Koala. So we might also say something like this, or 0.15 delta. There you go. Yeah, it got filled. Yours hasn't. Wiley's saying his hasn't gotten filled yet. So something to consider. There's our idea behind this. So that's kind of the approach here in this selling vertical spreads strategy on an ongoing basis, selling weekly index options to generate income. Guys, this is great in terms of the approach. Thank you for your thoughts as we kind of develop this. We're going to see how this works, and if we need to modify it, we're going to modify it as we go along. But really simple. Our discussion for today: selling a vertical spread on an uptrending index. In this case, 14 days till expiration, buying it back at 7 days to go until expiration, and looking to generate income on an ongoing basis. Guys, thanks very much. If you want to learn more about these strategies or any other strategies, jump out to the Trader Talks webcast channel, youtube.com/@Trader Talks webcast, and hit the search function right there. Follow Cam and myself on X @BenWatsonCS, @CameronMayCS. Remember to click on subscribe and like, and we will see you guys again very soon. And have a great day, everybody. Take care. Bye-bye.